So welcome to today's presentation. My name is Peter Joseph, Senior Market Analyst at IronFX. In front of your screens, you have your USDs for our chart. All charts to be presented are to be of the same time frame. As always, we're going to be mixing technicals with fundamentals in order to get a wider picture regarding the trading instruments movements and its outlook. Now, starting with Euro USD, we note that there have been some slight bullish tendencies during today's late Asian and early European session. It's characteristic how the pair is currently aiming for the 1.0890. Yet, actually, for a bullish outlook, we would require the pair to breach the R1 1.0890 and start aiming for the 1.0982. Given that the R1 now is set as the upper boundary of the current sideways motion of the pair. Once again, note how the price action has reached the upper Bollinger Band right here, and that may be slowing down the bulls somewhat. At the same time, note that the RSI indicator is above the reading of 50. It's actually nearer to 70, implying a buildup of a bullish sentiment among market participants for the pair, which could push Euro USD even higher. So for the time being, we tend to maintain our bias for the sideways motion to continue as long as it remains below the R1 1.0890. Should the R1 be broken, we would be inclined to switch our bias for the sideways motion into a bullish outlook. On the other hand, should the bears take over, which for the time being seems to be a very remote scenario, we would require the pair to break the S1 1.0795, which was a level providing support once, twice, 3, 4, 5, 6 times. So that's pretty valid. Should the S1 be broken and the pair starts aiming for the S2 1.07, that would allow us also to draw a downward trend line showing the limitations of the downward movement, and definitely would be highlighting the need to actually switch towards a bearish outlook. But for the time being, once again, that seems to be remote. The big question set at the current stage for Euro USD on a technical basis is practically whether the pair will be able to breach the R1 1.0890 and actually signal the beginning of a bullish outlook, or whether it will be hitting a ceiling at the R1 and correct lower, highlighting the sideways motion once again. We tend to view the pair mostly as USD driven and to a lesser degree Euro driven. And at this point, I would be noting also that we have ECB's interest rate decision tomorrow. And Euro traders may start positioning or repositioning themselves ahead of the release, even from today onwards. So we may see the influence of the Euro side increasing. Okay, let's have a look at USD JPY. USD JPY, which showed some bearish tendencies, however, seems to have failed to breach the 149.60 support line. So we tend to maintain a bias for the sideways motion to continue for now. It's characteristic also how the RSI indicator bounced before actually hitting the level of 30. So more or less, as long as the S1 still holds water, I would maintain my sideways motion bias. On the flip side, should the S1 be breached and the pair starts aiming for 147.75, we would be switching our sideways movement bias into a bearish outlook. While on the flip side, for bullish outlook, which seems improbable right now, we would require the pair to rise, breach the 150.80, and start aiming for the 151.90. Okay. Let's have a look at GBP USD. Now the picture here is a little bit different. The pair has breached the R1 1.27, now turned into support. So we're switching that, and let's go hunting for a new ultimate support resistance level. Releasing the chart. Let's move backwards here. Okay, we have a peak which is a little bit off balance, but still pretty valid in my opinion. So in red, that would be the 1.2995. Readjusting the chart. Starting with the R3, which is now being placed at 1.2995. 2870 should be the R2. The R1 at 1.2775. The S1 at 1.27. The S2 at 1.2615. The S3 at 1.2535. Now, regarding the direction of the pair, I think it's clear. We have an upward movement which is supported by an uptrend. And as long as the uptrend remains upward trend line remains intact, we tend to maintain our bullish outlook. I would be noting here also the RSI indicator, which it has bounced on the reading of 70, but remains close by. It's at 68 right now, implying that there is still a bullish sentiment for the pair left in the market. I would expect the pair to start aiming, if not actually breaching, the 1.2775, with the next possible resistance line being at 1.2870. On the flip side, should the bears take over, I would expect the price action to drop, breach the pre-mentioned upward trend line, signaling on a technical level the change of trend, or at least the end of the upward movement or the interruption of the upward movement, breach also the 1.27, possibly aiming, if not reaching. I would be adding also the possibility of breaching the 1.2615. Now, for cable, we have fundamentals which could affect, besides the US dollar, also the base currency, namely the GBP. And I would be highlighting UK Finance Minister Jeremy Hunt's speech before Parliament, the House of Commons in the UK, later today. Now, the UK Finance Minister is scheduled, or is expected to be more exact, to deliver the annual budget, and most probably, or sources are citing the possibility of tax cuts being included in the new budget. The big question here has also to do with how wide of a proportion to the population will those tax cuts actually affect. And in general, I would be noting that on a fiscal level, tax cuts tend to provide support for a currency, given that usually they are more supportive for the increase of economic activity in an economy. So as the main scenario, I wouldn't be surprised to see the speech by Jeremy Hunt actually providing some support to the pound and allowing the bullish movement to be maintained. On the other hand, I would be noting also Fed Chairman Powell's testimony later on in the late American session. And should the Fed Chairman actually defend the hawkish stance of the bank before the Senate, maybe even contradicting market expectations for increased, or if you prefer, earlier rate cuts by the bank, That could provide some support for the US dollar and could drive GBP USD lower. Let's have a look at USD CAD. Now, USD CAD remained in a sideways motion just below the 1.36, as was expected. We tend to maintain our bias for the sideways motion to be continued. Yet, I would be highlighting here that BOC's interest rate decision could alter the pair's direction. Let me rephrase that, the bank is expected to remain on hold at 5%. Currently, CAD OIS, that would be Canadian dollar overnight index swaps, imply a probability of around 98% for the bank to remain on hold. That should render actually the interest rate part of the decision as an open and shut case. So that's not the big question. The big question here are BOC's intentions. The market seems to be pricing in 4 rate cuts starting from June onwards. I would be noting here that on a macroeconomic level, the CPI rates of Canada have entered BOC's target range. Mind you that the bank desires inflation to be in the range between 1 and 3%. And the highest of the core and headline rates, that would be the core rate, entered also that range. It's at 2.9% year on year. So more or less, I would note that the deceleration, or if you prefer, the slowdown of the CPI rates in Canada allows the bank to start discussing or easing its hawkishness, which in turn could allow more or less for some innuendos regarding possible rate cuts in the near future. We're talking about the next 3 or 4 months. In general, should the interest rate decision and forward guidance, especially the forward guidance of the bank, actually point towards rate cuts anytime soon, we may see the CAD losing some ground. On the flip side, I would note that, okay, the core CPI rate decelerated and entered the bank's target range, but it has done so practically in the last month, in January actually. And more or less, I would expect the bank to maintain a firm stance, which would allow it to keep its options open about the timing of the first rate cut. So we may see the bank, on the one hand, acknowledging once again that the need for any more rate hikes is out of the question, but allow for some ambiguity regarding the dating of the next rate cut, the first rate cut. Should the bank actually maintain a more hawkish stance, which could be contradicting the market's expectations for a rate cut in June, then we may see the Canadian dollar strengthening and use CAD weakening. At the same time, once again, I'm highlighting Fed Chairman Jerome Powell's testimony before the Senate later today, which could also have a bearing on USD CAD as well, given that the base currency here is the US dollar. Okay, let's have a look at AUD USD. AUD USD, which seems to be testing the R1 0.6520. Definitely this has to be turned into support line. Yet the sideways motion, in my opinion, would allow for the resistance line to be edged higher. So we're pushing it upwards to 0.6535, given that we had a clear peak here, but the level was also tested once and twice here. On the other hand, I would be also pushing the S1 higher to this point here, given that we had that also tested down here, and that would be the 0.6475. So once again, let's try 6480. No, 75. Let's have a look and recalibrate the S2 and S3. Okay, we have actually mid-level right about here. Note how this level provided support here and resistance here. Also provides support here. Seems good. Keeping it. That would be the 0.6420. Practically, we recalibrated the resistance support lines given the low volatility the pair has been presenting. And it's characteristic how the corridor between the S3 and the S2 has narrowed to actually 70 pips. Resistance lines remain unchanged. That's not an issue. At this point, I would like also to have a look at the release of Australia's GDP rate during today's Asian session, which was of quite interesting. Okay, so we had the GDP rates well, but unfavorable in the sense that the GDP rate on a year-on-year level slowed down from 2.1% to 1.5%. Now, on the one hand, okay, the slowdown is notable. On the other hand, though, it was able to surface just a tiny bit higher than what was expected by investing at 1.4, actually. 1.5 is a tick up. So that was more or less adverse, but theoretically could provide some support for the Aussie. Let's have a look at the time of the release, drilling to the minute chart, unlocking it. Let's see if there was any market reaction at the time of the release of the GDP rates. No, there was no notable market reaction. Actually, the widest was 2 pips. So the market practically ignored it. Back to the forward chart. So I wouldn't expect any more support from the release, or in general, the release to continue influencing the price action of AUD/USD. So the sideways motion, in my opinion, tends to remain between the 0.6535 and the 0.6475. I would be noting, though, China's trade data, which are due out tomorrow. And it's going to be interesting to see whether the import growth rate is going to be accelerating or not. Why I'm saying this? Because China's trade data also tend to influence the Aussie, especially the import growth rate, given that Australia exports a wide number of raw materials towards China. So should there be an acceleration of the import growth rate, that could allow for some hopes that also Australian exports have increased towards China. And generally, such a scenario tends to provide some slight support for the Aussie. However, for the time being, that does not seem to be the case. And we tend to maintain our bias for the sideways motion between the R1 and the S1 to be maintained. For a bullish outlook, I would require the pair to breach the R1 0.6535 and start aiming for the R2 0.6595, a level which provided resistance right about here. While should the bears take over, we may see the price action dropping, breaching the 0.6475, with the next possible target for the bears being set 70 pips lower at 0.6455 pips lower, at 0.6420. It's interesting how the downward motion has been interrupted, given that the price action of the pair has breached the downward trend line. However, that was expected in the sense that note how the pair has difficulty to actually mark substantially lower lows. So more or less, that would be serving as a confirmation that the downward motion has ended. It's still not a confirmation of an upward movement, but the downward motion seems to have been interrupted here. Okay, let's have a look at gold, which reached new record highs and stabilized. Let's readjust the labels a little bit. So we tend to see here that the upward motion of gold has been interrupted, and that more or less happened after the price action hit a ceiling at the 2136. If we drill into the daily chart, we should be able to see here it is. This was the movement which set the 2136 as a record high level. And note how that was slightly surpassed during yesterday's American session. Since then, the price action of gold, back to the 1 hour chart here, the price action of gold has stabilized below the 2136 resistance line, back to the 4 hour chart, and that tends to more or less allow us for a sideways motion scenario to emerge here. On the other hand, though, we have to note that the RSI is still at very high levels. It's at 79, which it has flattened out, but still tends to imply that there is still a strong bullish sentiment among market participants. And should we see the US dollar actually weakening during the day, probably we may have a very interesting American Open here. We may see that gold's price could advance higher and clearly breach this time the 2136 and take aim of the 2180. For the time being, I tend to switch my bullish bias in favor of a sideways movement expectation just below the 2136. But once again, small bullish warning here should be in place. Let's have a look at Dow Jones 4 chart. Delete those labels here, they're out of use. Readjusting the chart. Okay, the price action has breached clearly below the S1 39,000. Let's turn this into support line, to a resistance line, sorry. Let's go hunting for a new ultimate support level. Unlocking the chart, going back. I'm highlighting this resistance level as a possible support level for the future. In green. Let's widen the chart. Let's work the labels. Starting with the R3 now set at 41,000. The R2 at 40,000. The R1 at 39,000. The S1 at 38,000. The S2 at 37,100. And the S3 at 36,290. So the price action was unable to clearly break the 39,000 resistance line. So most probably it actually moved below it. And the RSI indicator hit the reading of 30 at some point, yet currently seems to be bouncing off it, but it's still at very low levels. I wouldn't be surprised to see the price action moving even lower, possibly towards the 38,000 support line, which would allow us also to start drawing a downward trend line, showing the limitations of any downward motion. For the time being, though, I tend to maintain a bias for the sideways motion to continue between the 38 and 39,000 levels. It's characteristic that currently the price action is at 38,665, which is almost near the middle of it. On the other hand, note also how the price action was forced to stabilize after breaching the lower Bollinger Band here. Yet since then, there was some distance created, which could allow the price action to take a downward hill movement once again. Now, yesterday we noticed the discrepancy between the movements of Dow Jones and S&P 500. So it would be interesting to have a look at S&P 500 once again just before the close. Give me a sec. Now, what's interesting here are two elements. This is the daily chart of S&P 500, and I would be noting the drop of yesterday, which was in line with Dow Jones. That's clear. But on the other hand, note how the index remained above the upward trend line. So despite some signs of stabilization and the price action flirting with the 5,100 support line now turned to resistance, but in my opinion, that's still a support line as I expect the index to rise above it and start aiming for the R1 5,250. I'm maintaining a bullish outlook for the index, given the upward trend line remains intact. On the contrary, yesterday's downward motion was a confirmation of the bullish outlook, in my opinion, given that it has I wouldn't say bounced, but definitely gotten some support after nearing it. At the same time, note how the 20 moving average, the 100 and the 200 moving averages are all pointing upwards, implying a bullish outlook. So more or less, I would expect the price action to surface above the S1 5100 today and start aiming for the R1 5250. On the other hand, though, I have to note here that Jerome Powell's testimony before the Senate could affect also S&P US stock markets in general, hence also S&P 500. And should the Fed chairman sound hawkish enough, we may see the index correcting far, far lower. So that should sum it up from me. Hope you found this report useful. From all of us here at IronFX, best wishes for solid trading.
To another video of IronFX. My name is Emily and today we'll be looking at margin level. So what is margin level? Margin level indicates the health of your accounts. It is the percentage value based on the amount of equity versus used margin. In other words, margin level allows you to know how much of your funds are available for new trades. The higher the margin level, the more free margin you have available to trade, and the lower the margin level, the less free margin you have available to trade. A basic rule of thumb is the higher the margin level, the less possible it is for the trader to face a stop out. Your trading platform will automatically calculate and display your margin level. If you don't have any trades open, your margin level will be 0. So why is margin level so important? Forex brokers use margin levels to determine whether you can open additional positions. Different brokers set different margin level limits, but most brokers set this limit at 100%. This means that when your equity is equal or less than your used margin, you will not be able to open any new positions. If you want to open new positions, you will have to close existing positions first. Hope you found this video useful and interesting. In the next video, we'll be looking at margin call level.
I think we'll go ahead and just get started. So, okay, let's get started. So, as per usual, a risk warning and disclaimer. So, our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie, and I am an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research in the years 2019 to 2021. So here is our agenda for today. So firstly, we'll go through which time frames you should use for swing trading. And then we'll look at some graphical key elements, followed by identifying momentum. So this will be pretty similar to last week's momentum, where we talked a bit about the different indicators that you can use to identify the momentum. And then we'll look at breakouts versus reversals, as well as using correlation to fine-tune your strategy, because that tends to be pretty useful when you are looking at swing trading. So just let me know in the chat if there are any of you guys who like to use swing trading. I'm just curious to know as well. Okay, so here is a clear market structure example. So this is kind of the structure that we're looking for when we are going in for our analysis or choosing which time frames to use. And this is an example for an unclear market structure, an example that we want to kind of stay away from. Okay, so which time frame is the most important? For swing trading, okay, so before I get into that, I just want to show you guys that the more important thing is to look for clear market structures. So you can see on the M15 here, it's pretty unclear market structure, whereas on our H1 view, it's pretty clear shape. Yeah, so there's two criterion here. Firstly, we want to look for a clear swing low or clear swing high. And secondly, we want to look for a clear trend between the starting and ending point. So this can be used for support and resistance levels. If you're using pivot points indicators, that works as well, and even your Fibonacci levels as well. So as for which time frames to use for swing trading, these tend to be on the higher time frames. So 1 hour to about your daily time frames. So like yeah, so H1, H4, and the daily time frames as well. Those tend to be used for swing trading. Yeah, but as I mentioned, it's more important to look for clear market structures when you are determining which chart that you want to use. So I'll just do a really brief introduction to multi-time frame analysis. We went through this last week, but if you weren't here for our previous webinar, which was on day trading, I'm just going to briefly talk about this in this slide. So typically, traders will choose at least two time frames, such as a shorter term time frame and a longer term time frame. So it's basically a strategy that involves analyzing the market from multiple time frames so that you get an idea of the general trend of the whatever commodity or currency that you are trading. So the short time frame is used to identify the most recent trends and price movements, while the longer time frame is used to identify the overall market direction. So you want to look for key resistance levels, trends, and patterns. And these tend to involve looking at your indicators, looking at your Fibonacci levels, so on and so forth. So for example, if the short-term trend is bullish and the longer-term trend is also bullish, this could indicate a strong uptrend in the market. So conversely, if the longer-term trend is bearish, the trader may look to sell or short the market. As also if the shorter term trend is also bearish, then you would know that there is an indication of a strong downtrend in the market. So overall, multi-time frame analysis tends to help traders gain a better understanding of the market and gain more informed trading decisions by analyzing the bigger picture and trends and patterns from multiple time frames. Okay. So what exactly should you look out for? So price action wise, okay, these are obviously some of the basics that you should look out for on the higher time frames that you use for swing trading. But of course, in terms of price action, we're talking about past, present, and future momentums from the previous bar to dictate your strategy. So that brings us into our next point, which would be identifying momentum. Okay, all of these are kind of just tools that you can use to identify momentums and key levels. So the first key graphical levels, horizontal levels includes like your support, your resistance, and these tend to be supported with your Fibonacci levels, and including looking for Fibonacci confluence areas, so on and so forth. But we'll get into breakouts as well as Ichimoku clouds in the next few slides. And if we have time, I will also show you guys how exactly you can use these on an actual chart. Okay, so here, let's go through a couple of momentum indicators. So firstly, we have the MACD, and the MACD stands for Moving Average Convergence Divergence. So this line is calculated by subtracting the 26-period exponential moving average, or EMA, from the 12-period EMA. So the signal line is a 9-period EMA of the MACD line. Okay, so basically it uses 3 exponential moving averages to identify price movements. And the difference between these averages is shown in a histogram, which you will see in the next slide, which is just the charts. And then, the graphs. And then the movement can show whether a trend is strengthening or weakening. However, moving averages always lag behind price action and are more suitable for identifying entry points. So the MACD triggers technical signals when the MACD line crosses above the signal line to buy or falls below, which is a signal to sell. So here is the example of it, just so that you get an idea of what I'm talking about. So the MACD line is the blue line, signal line is the orange line. The histogram that I mentioned earlier is just your bar charts or graphs over here. And then your zero line is, of course, just the dotted line there. So a selling signal occurs when the MACD line crosses over the signal line. And then the bullish or buy entry is over here. So when the signal line crosses over the MACD line. It's just the opposite of here. Okay, so this is an example, and our sell entry is over here as well. So basically, you just want to take note of each of the crossovers because that tends to indicate a change in trend or change in direction of movement. Yeah. Okay, but it's important to note that these tend to be lagging indicators as well. Like you can see over here, only when price has shown a reversal, then the next few lines, then we see price crossing over and indicating. So basically the red area indicates a sell. So this, yeah, it's pretty much a lagging indicator. So just keep that in mind if you're intending to use your MACD. Okay, let me know if there are any questions throughout the webinar. Okay, next, next momentum indicators, we're going to look at RSI as well as stochastic oscillator. So RSI oscillates between 0 and 100. Values above 70 are considered overbought and values below 30 are considered oversold. So when the RSI value is above 70, it suggests that the security may be overvalued and due for price correction, potentially indicating a sell signal. And when the RSI value is below 30, it suggests that the security may be undervalued and due for price rebound, potentially indicating a buy signal. For stochastic, the readings above 80 indicate that price is near its high, and readings below 20 indicate that prices are near the lows. A security is overbought when the K line moves above 80 and oversold when the K line moves below 20. So here is an example for stochastic. So how we like to use stochastic as well as RSI is by looking at hidden resistances, divergences as well, which we'll get into in a little bit. But we do have webinars purely on divergences, so you could go and take a look at those as well. But I'll briefly go through those now. So what we mean by a hidden resistance is that on our stochastic, we see that we have multiple swing highs that line up nicely at this 93.52 line. And on our price chart, we have price making a higher high at each of these lines over here that we've highlighted. So this is what we mean by hidden resistance, and then we can expect price to continue to respect this level here. Okay, here's another example of a hidden support or resistance. So we see that we have, and once again, we are using a stochastic indicator. So we have a hidden support level in this case, and on our stochastic, and on our price chart, we have this increasing trend line. Okay, so just to recap, what makes a valid trend line is if there are three significant touches, and you can see that we are expecting price to continue to respect this line because firstly, we have this ascending trend line, secondly, we have a hidden resistance here. Okay, and you can see that's exactly what it did, pushed it all the way to our take profit. Okay, so over here is an example of how we are using multiple indicators. So here we have the trend line, that's the first indicator. Second indicator, we're using the stochastic hidden support level. And we are also using our horizontal levels, so support and resistance levels, swing highs and swing lows to basically to find confluence and analyze or forecast that our prices are going to rise to our take profit level. Okay, so I mentioned earlier a bit about divergences. So here is the first example, which is a bearish divergence. So bearish divergence happens when an RSI or stochastic has a descending trend line, or descending or descending. If it's bullish divergence, then that would be ascending. So so here's an example, whereas on our price chart, we can see that price is either respecting a horizontal resistance or it is making a higher high. Okay, so in this case, we see that price is making is respecting a horizontal level. Okay, first point, price is testing a key horizontal resistance level with price making a smaller high, resulting in bearish divergence with RSI. Whereas on our RSI, we have a descending resistance line, which is basically descending trend line, and it caught the two reversals correctly, which you can see on our price chart. So what this forecast is that we could be seeing a reversal here as well. Okay, and you can see that's exactly what happened. Price reverses strongly because of the horizontal resistance, RSI resistance plus bearish divergence. And we can see that the RSI has also reversed very strongly. Okay, here's another example. Here is a little bit more straightforward. So we have price making a higher high and our stochastic making a lower high. Okay, and yeah, you can see that immediately after this divergence, price immediately dropped on on our price chart. Okay. So this is an extension of the previous example. In this example, we see price immediately drop, but we can see that it's rising again and it's approaching our resistance level here. So it's approaching this resistance level and we see a repeated pattern with the ascending, or rather price making a higher high and stochastic making a lower high. So it's the same pattern. We also have a hidden resistance level between these two swing highs, and you can expect price to continue to drop, which is why we call it a bearish divergence. And that's exactly what happened over here. Okay, divergence potential. So in this example, we see that we want to take note of where the bearish divergence started. So that's why you place a vertical line over here, as well as where we intend it to approach. So in this case, we see the bearish divergence making a higher high from this level to here, whereas our RSI is making a lower high from here to here, which is why we place our vertical dotted lines at these areas. Bearish divergence tells you that price is making a higher high, RSI is making a lower high. So we also highlight this area because price tends to reverse to the previous level where it started to diverge. So this is also basically a pullover, um in this case support level, okay, because we see that price is expected to pull back to this same level here, pull back or retrace back to this level. And you can see that's exactly what happened here. Price reversed to where the divergence started to occur. Okay. Now, forecasting breakouts. We see this ascending trend line and on both our price as well as our RSI. But on our RSI, we can see that price has recently broken out of this ascending trend line, which forecasts that price might we might observe the same thing over here. And you can see really close, if you look really closely, that price is barely breaking out of this ascending trend line, but also shows strong recent bearish divergence versus RSI. So we have a couple of pointers here that support our analysis that price is going to break out of this ascending trend line. Firstly, we have the RSI breakout over here. Secondly, we have the bearish divergence with price making a higher high and RSI making a lower low. Next, we have price breaking out of this ascending trend line here. And all of these points suggest that there is a high probability that our analysis that price is going to break out of this ascending trend line is actually going to happen, which you can see price broke and dropped strongly. Okay. Here's another example. In this case, we are seeing a descending. Okay, well, this is not a descending trend line because, as I mentioned earlier, we need 3 points for it to be considered a valid trend line. But this is a descending resistance line because we see these two swing highs on our price chart, and we also see the same two lines at the same spots for our RSI. Okay, so we see that our RSI is breaking out of this resistance level. Yeah, it's breaking out of this resistance level, and that's a suggestion or forecast that price is going to break out of this descending resistance as well. Okay. Okay, so price is now testing the descending resistance line. We're wondering if it's going to break it. Secondly, we have a descending line breakout, as we mentioned earlier, but we also have a bullish divergence. So bullish divergence is basically the opposite of a bearish divergence. So we see that price is making a higher low on our RSI, and on our price chart, it's making a lower low. That's basically bullish divergence. So when you draw it out, it should look like this. Okay, so it suggests that price is going to continue to go upwards and break out of this descending resistance. Next, let's move on. So now we are looking at how we can play the continuation or breakout and reversal. Okay, so this is just a checklist for you to follow, especially if you are a beginner trader. It's just a good checklist to take note of a couple of things, or check for a couple of things when you are doing your analysis. Okay. So firstly, we have playing the continuation. Next, we're gonna look at playing the breakout. Okay, but we're looking at continuation first. So firstly, we want to see is price respecting Ichimoku. Secondly, is price respecting any trend line. Thirdly, is there any key horizontal support resistance level, Fibonacci levels that support these levels, and where's the next key level that it might go? Okay, so in this example, we are looking at a trend channel. So it's very obviously an ascending trend channel. What makes it valid is if there are two touches on top, two touches below, and you can see that it's continuing. So we are playing the continuation. What we mean by bounce and reversal in this case is not so much a reversal in trend, but more a reversal in terms of touching the walls of the trend channel. Okay, we see bounce off of the trend channel. That's basically what we mean by bounce and reversal in this case. Not so much breakout of the channel, and that's why we call it a continuation, because it's still continuing within the trend channel. So it's still moving within the trend, the ascending trend. Okay. Next, up on the other side, we are also looking at a descending trend channel just in the opposite direction. So we also see it bounce off of the walls of the trend channel just in a downward trend. Okay. Next, let's look at playing the breakout. So when we play the breakout, we mean crossing below the Ichimoku cloud. Whether the momentum is in accordance to your analysis, did price break any trend line? Did it break any recent key horizontal level? Or key Fibonacci confluence areas? And where is the next level that it could break out to? And then we fine tune it with Fibonacci levels and support and resistance areas. Okay, so in our first example, we are playing the breakout from this multiple swing high resistance. Okay, these tend to be areas more so than specific levels, which is why you can see that we've highlighted this area here. Okay, so price has broken out of it. We are expecting it to continue moving upwards for a couple of reasons. Firstly, we have this next swing high resistance here at the 135.147 level. Second point, we see it moving above the Ichimoku cloud, so suggests that it's a bullish signal. And then thirdly, we see that we have a 78.6% Fibonacci projection that also lines up with that same level. Once again, it doesn't have to line up exactly at the same level. I mean, it would be nice if it did, but these tend to be confluence areas more so than levels. So as long as it's near or close to it, that's fine. Okay, you can see that's exactly what happened here. So we moved above the 61.8% Fibonacci projection and move next, rise next to the next swing high resistance. Next, we have, in this case, a descending trend channel. Okay, so when we say breakout, you see it moving, still moving within the descending trend channel. So that's playing the continuation. But what we mean by breakout is you can see it's breaking out this ascending trend line. Okay, and it's also moving just below, or rather it's breaking out of the Ichimoku cloud. Okay. So we see this swing support at the 1.03488 level, and we're expecting price to continue to drop to that level, which you can see it did nicely here. Okay, next, playing another breakout. In this case, it's breaking out of the ascending trend channel. So in this case, we are using an inverted Nike tick or a Fibonacci extension. So for Fibonacci extensions, we look for ticks, or Nike tick, or basically anything in the form of a V shape, as long as the tail of the V shape is longer than the head of the V shape like you see here. Okay, so in this case, it's kind of inverted. So we see the 127.2% level. That's where price is at now. And the 161.8 is at this swing low support here at 0.66420. So we're expecting price to break out of this 127.2 and continue heading towards our 0.66420 level. Okay, and in this drift, you see that price it does test the 127.2 level a little bit, but you see that it ultimately does break through and hit our 161.8% extension level as we expected. Okay. So in the next example, price recently broke out of the descending trend line. Okay, so we see it break out, and we're going for a buy entry at the 100% Fibonacci extension. Okay, once again, this is a Nike tick. I think you can see the tick a little bit clearer now. So we are expecting it, or we are projecting it to hit towards our take profit, as well as the 161.8 level. Okay, and you can see that's exactly what happened. So it does test the 127.2 level. So that's what we can kind of expect it to do. But ultimately, it would still hit our take profit. And it's not just by using the Nike tick or the Fibonacci extension strategy. We combine that with the upward momentum from breaking out of the descending trend line, and also from this buy entry and the take profit, which are all levels of swing lows and swing highs. So pretty significant levels to take note of as well. Okay, next we're gonna move on to correlation, but before that, let me know in the chat if you guys have any questions so far. Seems like we're all good. Let's move on to correlation. So when you're swing trading, correlation can be a pretty helpful strategy by comparing two different financial instruments or assets. So could be your stocks, currencies, commodities, so on and so forth. Okay. I mean, of course, in this case, we are talking about Forex. So you can compare two Forex currencies that you're looking at in order to see or predict the different directions that they're heading towards. So a positive correlation means that the two assets move in the same direction, and negative correlation means that they move in opposite directions. And for example, if the price of gold and the value of the US dollar have a negative correlation, then when the price of gold goes up, the value of the US dollar typically goes down and vice versa. So the perfect positive correlation is +1 and a negative perfect correlation is -1. So in order for it to be considered strong correlation, we look for values of 0.8 and above or below negative 0.8. So basically 80%. Okay, so what exactly is it in the context of Forex and trading? So traders will use correlation analysis to identify potential trade opportunities and manage risk. So if a trader holds a long position in a Forex currency, they may want to consider taking a short position in a negatively correlated currency to offset some of the risk of the long position. So it's important to note that correlations can change over time. So traders must continually monitor their relationships. Additionally, correlation does not equal causation, meaning that just because two assets have a high correlation, it doesn't mean that one is causing the other to move. Okay, so here I have an example. My FX book has a correlation table that you can use to find the most or least correlated forex currencies in real time. So yeah, I've highlighted the time frames. You can choose if you're looking at a higher time frame, lower time frame. It's all there for you to adjust. And you can find currencies with correlations higher or lower than a certain percentage. So we typically will recommend looking for correlations higher than 80 and lower than negative 80%. So you just have to put that into the filter and you'll highlight all of the currency pairs that match up with what you have requested, that you can see over here. So it's a very easy way of finding correlations. Okay, they have pretty much all of the major currencies as well as a couple of exotic ones. So you can go on to myfxbook.com and take a look and play around with the currencies on your own. There's another correlation table from CMC. Yeah, so just giving you examples that you can look at. So here are a couple of correlated currencies that are positively correlated. So we have firstly the AUD and the Kiwi dollar, the euro and the pound, dollar index, CAD, and Swiss franc. Okay, so firstly we're going to look at the Australian dollar as well as the Swiss franc in this example. That is 84.2% positively correlated. So in this first chart, we're looking at AUD/CHF, and this is what the chart looks like at that time in the 1 day time frame. And this is what the AUD/CAD chart looks like, also in the same time frame. So it's important that you want to use the same time frames to compare. And you can make use of the trading view feature that allows you to compare the charts at the same time. Okay, so yeah, so this is basically what it will look like if it is very correlated at that point in time. So you can see, yeah, whenever prices move upwards and downwards, it's basically about the same shape, I mean. Okay, and in this case, we are looking at pound dollar as well as the pound yen, and you can see that at this point in time, they are pretty much the same shape as well. So if you are analyzing the pound dollar, just solely by technical analysis, not taking into account any news events, any policy decisions, just by looking at technical analysis, if you analyze on the pound dollar, you can pretty much implement the same analysis for your pound yen, since they are pretty much almost the same and very positively correlated at this point in time, in this example. Okay, but of course things do change and it's important to look at your fundamentals as well, which is why before you do this, it's important to look at the MyFX book correlation analysis so that you know exactly how correlated it is. Okay, another example, Kiwi dollar and Japanese yen, as well as the Aussie dollar and Japanese yen. So you can see once again that it's very positively correlated. Okay, another example, Kiwi dollar and Aussie dollar. You can see it's pretty much the same. Yeah. So if you can't see, it is a little bit difficult to see just by comparing these two charts, which is why we like to use the trading view feature that allows you to compare two charts on the same chart. Two currencies on the same chart. Okay. This is another example. We're comparing the SPX with the euro dollar. And you can see they are also positively correlated. I think you kind of get it by now. So let's move on to negatively correlated. So negatively correlated currencies, some examples tend to be the DXY and gold, as well as the DXY and the Aussie dollar. So in this example, we are looking at the Euro Aus and Aus franc, which are minus 90.9% correlated. Okay, so this is the Aus franc. Okay, and this is the euro dollar. So you can already see that these charts pretty much look nothing alike, and you can see that's exactly correct. So whenever prices are dropping on our euro Aus, you can expect it to rise for our Aus franc and vice versa. Same thing in this example, we are looking at Aus dollar and dollar CAD. It's basically the opposite. Okay, and on the SPX and gold as well. So if you look at this chart, whatever you analyze on the SPX, just purely technical again, you can pretty much just reverse that for the gold analysis. So here is gold and US dollar, which tend to be negatively correlated a lot of the time. But of course, once again, remember to check before you do your analysis. Okay, and yeah, that brings us to the end of our webinar. Let me know in the chat if you guys have any questions, but if not, thank you guys so much for joining me today. Have a great rest of your week, and I will see you guys next week. Bye, everyone. Thanks, guys. Bye.